All right, ladies and gentlemen, boys and girls, welcome back to the TLDR, Too Long Didn't Read Finance, where I'll do my best to give you a quick oversight into the topic at hand and then stick around for the more in-depth dive about all the particulars and the fine print and that sort of thing. So that if you do stick around, you will feel really comfortable about said topic. But if you just want to do a quick flyby, I'm here for that too. So today we're going to talk about order types. Can't tell you how many times I get this question. I do work in the industry, and clients constantly will call in. Hey, can you help me place a trade? Great. What does this mean? What are these different orders um, types, and what does it mean? What's a limit market, stop market, etc. So the basics here, again, I use TD Ameritrade as my personal broker. Use whoever you want, doesn't matter. They should all have some of this basic information at your disposal. Within the account, I'm going to point out, so if I were to place a trade on the website, these great question marks. This is how TD does it. I'm sure all the other firms have something similar of like a hint or a helpful hand. You click it, boom, order types overview. So the quick snapshot, the too long didn't read, market orders seeking execution of buy or sell transaction immediately at the next available market price. I say the market orders guarantee execution, assuming market hours are currently going on and it's not after hours or the weekend or something like that. Market order, you place a buy order for 10 shares, you're going to get 10 shares the moment you hit submit. The price can move on you a little bit, because again, all we're doing is guaranteeing execution. We're not guaranteeing a price. So you're going to get your 10 shares, and if it's a big traded stock, it might only move a little bit, a couple pennies here or there. Not that big a deal for it. Limit orders, order seeking execution of a buy order or selling. Let's see if we can make that a little bigger for you. There you go. Or a specified price. So limit orders guarantee price. They don't guarantee execution. So if you get filled, you will get filled at the price you designate or better, but it doesn't guarantee that you get filled. So if you put an order, some ABC stock is currently trading at $100, and you want to get just a couple nickels cheaper at 9.90, excuse me, $99.90, great, more power to you. Put the order in. But as a limit order, if it never comes down to 9.90 or 99.99, wow, $99.90 or less, you could miss the run. You won't get your shares. You won't have the piece. So, and we'll talk more about how you can, trick limit orders to work like market orders, and that sort of thing. But limit orders are also great for fast-moving markets, right? Market orders can be all over the place. If you've been trading for any amount of time, you probably got a terrible fill where the stock's trading at 100, but you got filled at 103. $3 is a terrible, huge gap, or slippage is the term for it in the industry. But it does happen, and that's the downside to market orders. Yeah, you got your execution, but you got a terrible price, and your slightly winning trade might now be a slightly losing trade. So limit orders, again, good for price action, good for fast-moving markets. Stop orders are for you're in a position, not necessarily, sorry. Stop orders are a particular order usually used for getting out or protection. So you're in a stock, you want to get out if it drops below a certain price, you could use a stop order for that. You can also use stop orders to enter a position. We'll talk about that briefly today and more in depth later on. But again, in order to buy or sell security at the next available price if the price reaches or surpasses a designated level. Again, we can buy or sell. Typically, again, people use this for protection. So they're in a position already. They want to set a stop limit at the under the current price of, hey, if it gets to this, I want to stop the bleeding. I want to get out, and that will do it for you. You can do stop orders for normal market hours only. You cannot use these during extended hours. Trailing stop, similar to the stop order, buy or sell with an automatic, but it does adjust. Think of it like a ratchet on a wrench or stairs, if you will, and we'll try to find a visual for you here. But it follows the price up or down as it goes in our favor. However, if it starts to retrace that trailing stop does not go down with it. So it will only ratchet up or stair step up at whatever percentage or dollar value you want it to be. So if you want a 5% trailing stop, it will follow that rally 5% behind it and then continuously until either you cancel it and close out the trade manually, or it cancels it because the underlying stock retraced or reversed or went against you by 5% or more. Again, you can use that for buying or selling. Typically, like the stop order, used for protection for positions we're already in and to stop the bleeding and get out. And that's a too long didn't read. Now we're going to go a little bit deeper. On the platform, of course, I think we're going to get rid of that for a minute. We've got some other ones here, right? So I said trailing stop percentage, trailing stop dollar, stop limits, stop markets. Pretty straightforward here. Stop market is going to guarantee execution if our price is hit. Stop limit is going to guarantee our price, but not execution if our price is hit. So bit there, but I want to go into education, of course, because that's the biggest thing. Most people come in, drop 10 grand, drop 200 bucks, whatever it is, immediately want to place the trade because that's the fun part. And then they do something simple like put in a limit order after hours without changing the time in force, and calling and screaming or getting mad that the order didn't fill. Why didn't the order fill? Well, you didn't tell. It's a dumb system. You didn't tell it what to do. So time in force is important. Again, question mark here to help explain it. Simply there, by default, most orders go for only market hours. And so if you want to trade after hours, which is a viable option, stock market's actually open for several hours before and after the normal market hour range. But you need to tell the system, hey, I want this order not to wait until tomorrow's market. I want it to trade right now in the extended hours. And you do so, at least on TD Ameritrade, by selecting this plus extended in whichever piece you want to do. Day, of course, means for a single day. Good till cancel is good for up to 90 days at TD Ameritrade, and similar brokers are 60 to 90 days. But the extended hours is the important part. So if I place an order, markets, even the extended markets closed now, but if it was 6 o'clock earlier today and I wanted to buy some shares, I could, but only if I selected plus extended. If I left it as day, it would actually wait until the following day, normal market open, before it would start to work. So that's a big piece that's in tandem with order types for it. So let's see here. So a couple things, right? So if we're under education and we go, I think just stocks, you'll see it's several of the first videos in the lineup here are stop orders, stop limit, market, different order types. Very important thing. Gets done wrong all the time with clients. They call up mad at us, mad at whoever else, because they didn't take 5 minutes to learn the different order types, how to use them, when to use them, to make sure they can get in, they can get out of the trades themselves. So at least on TD Ameritrade, come here. I'm sure, again, all the other brokers have their own education on it. YouTube it, for God's sakes. Spend the 5 minutes, watch the video real quick, or at least read the order types that we found back here, right? At least read through these. And if you click each one of them, they go in a little bit more depth. Great. If you clicked on all these and read them, probably less than 5 minutes. But you would save hundreds of thousands, who knows how much money has been lost because of improper order etiquette and order type usage. So we're going to wrap up a little bit here. Not wrap up. So second to last piece. And we're going to talk about this lovely chart. So in our Series 7 is when I first saw this, but slobs over bliss. So of course they added these two letters here just to make it somewhat an acronym here, but this middle line is the price that the current underlying or the current stock is that you're looking at to purchase. And this is back to the piece when I said stop orders and trailing stops can technically be used to buy and sell. This graph helps, or this visual helps with that. So if our stock here, this line again in the sand, is ABC stock or whatever stock you want it to be, again, as always, any stocks are purely examples. I'm not trying to tell you what to do or give you advice or tell you which direction, anything like that. But ABC stock's at $100 and we want to buy it, but we're a technical trader. We don't want to buy it until it hits $105 because that's when our breakout is showing to happen. That's when we think the chart's going to run. But if it doesn't hit 105, then it's not going to run. We don't want to buy it. We're out. So that's the example we're leading to. If I want to buy it right now, great. Buy is the action. Order is market. I guarantee to get my shares at the current price, roughly, with a penny here or there moved depending upon what you're buying. Great, I got my shares. I'm gonna along for the ride. I'm ready to go. If I want to wait, but I want to enter the order now because I'm busy with work or the kids, I don't have the time. I don't want to watch it. I want to set it and forget it. Great. You can go to the order, and in this case, you do buy. 10 doesn't matter. Order type would actually be stop, and then our activation price. So again, this would be 105 because we want to wait until the stock hits 105 or higher. And now what happens is this will, let's see if it'll actually explain it to us. Review order. So buy 10 shares when the activation price is 105. Right? So I could submit this. It'd be good for the rest of the day, waiting for 105 to happen. Great. I can walk away. I can go do the dishes or laundry or play with the kids, what have you, and come back later. It fills or doesn't. No big deal. Sell limits. We'll stick to the top part here. So price is currently at $100, except I already own shares that I've had before, or I want to sell short, but I want to sell it at a price that's higher than where it is. So we're going to stick to the long side. I own 10 shares of ABC at $90, and I want to sell those for a profit if they hit 105, but not before then. 105 or higher, or better in this case. I could enter a set and forget order for a sell limit at 105, right? So I already own 10 shares. I could say sell 10, limit 105. Now the difference, right? I did a buy market or buy limit. You can do that similar as well. Buy limit waits to buy until 105. In this case, I want to sell for a profit. Again, we bought them at 90 in our example. I want to sell at 105. So I enter this order to wait. Now typically this is we've already bought them, so we're willing to wait as long as it takes for this 105 to be hit. So I would change this also to probably a good till cancel plus extended hours. So anytime extended hours or normal session over the next 90 days, if this stock hits 105, it's going to sell me out for my profit of $15 a share. That's how we use sell limits. So now we're going to move to the bottom of the piece here, and we're going to go with the reds here, the bliss. So in our example before, so again, stock price is currently at $100, but we want to kind of wait. We think some turmoil is going to happen, or just some motion of the ocean of markets is going to happen, and it's going to drop $2 by the end of the week, and we're willing to wait until that $2 drop has happened before we engage our buy order to get into this position. So in that case, we're trying to enter a price below the current market. We want to buy, so we're going to be over here on the buy limit. Right, so we're buying limit, except we want to wait till 98. And that's it. And now this will wait, again, 90 days, anytime during normal or extended hours if this stock hits $98 or less, if a gap happens and it opens at 97 or something like that, it will buy you at our price, 98 or better. 97 is better than 98, and you will have your 10 shares of the security. And similar, to round it up here, we're in the position. The price is currently below where we entered. Or no, sorry, the price is still $100. It's right the current market price. We own stocks or shares already at $90 a share. And we're doing good with the profit. We like the profit. However, we're worried. There's some upcoming news. There's some earnings. Whatever the reason is, we're worried that it might drop. And so if we want to lock in our profit in this example, again, we own shares at 90, stocks currently at $100. So if we want to guarantee a profit, or we'd like to secure a profit or protect some of our profit, we would enter a sell stop order. So that is information to sell the current shares that we have at a designated price below the current market price. So in this case, we want to save at least $5. So we come over, we do sell, we can do a stop, and we would say 95. Now again, as I mentioned in the initial part, stop market orders or stop orders are only allowed during normal market session. You cannot enter a stop market, at least at TD Ameritrade, for extended hours. You can still make a trade that happens in extended hours, but it wouldn't be a set and forget stop, sell, stop order. And so yeah, so in this case, earnings goes bad, Trump tweets, any sort of news that goes on that forces the stock to fall. During market hours, we would be triggered at $95 to sell our 10 shares and get out of the market. Then, of course, the difference between a stop limit and a stop market, we have two extra prices because, again, we're setting a stop, which is our activation, for an order to work. The first example, stop market, our activation, $95, activates a market order. And what does market order do? Guarantees execution. So it goes out right away, fires off a sale for 10 shares, gets you out of the position. It may be 94.99, it may be 95.02, but it's going to be pretty close to that. But that 95 is what triggers the market order, gets us out of the position, guarantees execution during the right session, during market hours. Stop limit, our activation is the same at 95, but all that does is activate a limit order. So we're going to have two prices we need to enter here. Typically, most people would just enter the same price twice. And for a typical market that's moving normally, not a big deal, should get you out each time just fine. Again, limit orders, the price has to be hit or nothing happens, right? Our price or better. So we're selling at 95. So if it hits 95 and waits for at least a half second or whatever short time frame the market makers are working with, you should be able to get out for $95 or better. If it hits 95 and goes to 95.02, great, you're going to get the 95.02. You're going to get the better fill for that. Now, the reason I mentioned you should get out if you enter these two numbers the same is if a falling market or a fast-moving market is occurring, and we enter 95 to activate this order, and then let's say it immediately jumps to 94.75. Well, is 94.75 less than 95? Yes. So that is below our price. That's the worst fill. So we would actually be left with a working limit order. The order is still working. However, it's waiting until $95 or higher is hit again. And if the market's falling like a hot knife through butter, it may not hit that 95 again, or at least not for a while. And you may wake up the next day with a sell order working. However, the price is now $90 or 40, God forbid, something like that, right? So I try to encourage clients, it's a bit of an advanced piece, but make this something slightly different. 94.50. Give yourself a little bit of cushion in between there. Again, you're going to get the better fill. So if it's a good market and 95 is hit and 95 is the best price, even though you put 94.50, you're going to get filled at 95. But this 50-cent cushion will help make sure that you get out of the position instead of get left holding the bag as the stock potentially plummets much further and you lose much more than you plan to on the position. So that's it on order types. Again, slobs over bliss. You got your price of current market in the middle, and then do you want to buy or sell or what have you, and that should help get you straightened out. Make sure you do some education, do some reading on the order types. Ask Ted if you're a TD Ameritrade client. Search order types in the box here. You can go to videos. Bam, you got your 5-minute one right there. You've got other types. Lots of good information. Or call the service center, the 1-800 number, and just ask somebody about it too. That's absolutely another way. Might take you more time than 5 minutes to watch the video, but it will get you and potentially, again, save you a lot of headache and a lot of trouble and potentially a lot of dollars in the future to know those. So thanks again for watching. I'm your host, Matt, and until next time, guys, have a great day.